Want to invest in a world-class business that Warren Buffett is also invested in? Would you like to collect safe, growing, market-beating dividend income? Like the idea of getting a good deal on a great stock? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing the world with life-improving and life-saving pharmaceuticals. High-quality drug companies are almost a lock for steadily increasing profit and dividends over the long run. Our world is growing larger, older, and wealthier. There are simply more people walking around, living longer than ever, and making more money than ever. There's a straight line from that to higher demand for quality medicines. And from there, another straight line to rising dividends for shareholders of this business. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Merck & Co. Inc., which appear to be trading at a significant discount today. Merck & Co. Inc., stock ticker MRK, is a leading global pharmaceutical company that produces a range of medicines, vaccines, and animal health care products. Founded in 1891, Merck is now a $192 billion by market cap healthcare behemoth that employs more than 70,000 people across the world. The company operates across two reportable segments: pharmaceutical 90% of fiscal year 2020 sales, and animal health 10%. Insignificant sales occur in unreported segments. Their core areas of focus are diabetes, infectious diseases, oncology, vaccines, and animal health. The US is the company's largest market, accounting for over 40% of worldwide sales. Some of the company's key drugs include Keytruda, Januvia, Gardasil, and ProQuad. Keytruda, their wonder cancer drug, is the company's most important product. It's by far the top-selling drug in their portfolio. This single drug made up almost 30% of the company's worldwide sales for fiscal year 2020. That compares to nearly 25% of company revenues for fiscal year 2019. So this drug is becoming a larger piece of a growing pie. The company's biggest product is also one of its fastest growing products. That's a great position to be in. Also, Keytruda isn't only Merck's best-selling drug. At almost $15 billion in sales for fiscal year 2020, it's one of the top drugs on the planet, second only to Humira, and it's forecasted to be the best-selling drug in the world by the middle of this decade. Based on its growth, that seems likely. Keytruda sales grew by an incredible 30% year over year for fiscal year 2020. This drug is on patent through 2028 in the US and EU. Merck is an incredibly profitable business operating inside of an incredibly profitable industry. And with the world's demand for quality medicine sure to rise over time as the planet grows larger, older, and wealthier, Merck has tailwinds that are gusting its way. That bodes well for the company's ability to continue making more money and paying out larger dividends. They've already increased their dividend for 10 consecutive years. The 5-year dividend growth rate is 6.3%, which is something they've been pretty consistent with. Indeed, the most recent dividend increase announced in November came in at 6.6%. This growth comes attached to the stock's current yield of 3.4%. That yield, by the way, is 50 basis points higher than the stock's 5-year average yield, and the dividend remains protected by a payout ratio of 43.7% using adjusted fiscal year 2020 earnings per share. This is a very appealing combination of yield and growth. I consider the sweet spot for a dividend growth stock to be a yield of between 2.5% and 3.5% backed by a mid-single digit or better dividend growth rate. This stock is right there. Looking at business growth, Merck's revenue is basically flat between fiscal year 2011 and 2020, moving from $48.047 billion to $47.994 billion. However, I think it's more appropriate in this case to zoom in and look at more recent top-line growth. Keytruda came on the scene in 2015, and Merck's revenue is up more than 20% since fiscal year 2015. Meanwhile, earnings per share increased from $2.02 to $5.94 over this 10-year period. That's a combination compound annual growth rate of 12.73%. Notably, I used adjusted earnings per share for fiscal year 2020. That's due to the fact that fiscal year, the GAAP earnings per share included acquisition costs and intangible asset impairments that aren't really reflective of the company's actual earnings power. Share buybacks definitely help bottom line growth. The outstanding share count is down by almost 18% over the last decade. Looking forward, CFRA is forecasting that Merck will compound its earnings per share at an annual rate of 10% over the next 3 years. I view this growth assumption as both reasonable and compelling. Based on recent results, this is not a stretch for Merck. I don't see this as a difficult hurdle for them to clear, and while it would represent a drop compared to their 10-year earnings per share growth rate, it would still be a very good result that can support like dividend growth. Moderate payout ratio further supports this. Merck's pipeline is robust with 38 programs in phase 2 and 22 programs in phase 3. The company has time to develop programs because of the multi-year runway for Keytruda. I'll point out that Merck is expecting non-GAAP earnings per share to come in between $6.48 and $6.68 for fiscal year 2021, which would mark 10.8% year-over-year non-GAAP earnings per share growth at the midpoint. That's right in line with where CFRA is at here. In addition, Merck previously announced they would spin off their women's health, legacy brands, and biosimilars into a new company called Organon, expected to complete in the latter part of the second quarter of 2021. This is exciting for Merck shareholders. Spin-offs historically perform well, and it focuses the legacy business. Merck's most recent dividend increase announced in November came in at 6.6%. This was a solid dividend raise during a pandemic. The future looks even brighter. Moving over to the balance sheet, the company maintains a great financial position. The long-term debt to equity ratio is 1.0, while the interest coverage ratio is over 11. The balance sheet is actually better than it looks. Shareholders' equity has been artificially lowered by treasury stock, which is due to the aforementioned buybacks. In reality, they have a balance sheet that is more than satisfactory. Profitability is impressive, and recent numbers have been exceptional. There's been a pronounced margin expansion since fiscal year 2016. Keytruda's outstanding performance is largely responsible for this. Over the last 5 years, the firm has averaged annual net margin of 13.96% and annual return on equity of 19.44%. In many ways, Merck has arguably never been better than it is right now. It's operating at a high level across the board, and the business is protected by durable competitive advantages, including economies of scale, a global distribution network, patents, IP, and a very large R&D base. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The company's biggest opportunity might also be its biggest risk. Keytruda's massive success is starting to become an overwhelming portion of the company's sales. This linchpin drug could start to weigh on the business and stock in the future after patent protection comes off. Any changes to the complex US healthcare system would likely affect Merck. The company's pipeline has pressure on it to produce successful drugs in order to support sales and rationalize R&D. There's always pipeline risk with a pharmaceutical company. Even with these risks, I believe Merck can be a fantastic long-term investment. That's particularly true with the stock well off of its pre-pandemic price of over $90 and the valuation being attractive. The stock trades hands for a price-to-earnings ratio of 13 based on adjusted trailing 12 months earnings per share. Adjusted earnings per share makes comparisons difficult, but I think this is representative of where the valuation is at. We can also move past messy earnings per share and go straight to cash flow. The price to cash flow ratio is 19.0, which is demonstrably lower than its own 3-year average of 19.8. And the yield, as noted earlier, is materially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate might look slightly aggressive in comparison to the demonstrated 5-year dividend growth rate. However, I'm also looking at the moderate payout ratio, long-term earnings per share growth, and near-term earnings per share growth rate forecast. Simply put, this company is in many ways better today than it's ever been. With Keytruda going stratospheric, the company will have the capability to produce dividend raises that are higher than what they were in the past. I'm assuming a very small acceleration in dividend growth, which is not unreasonable when looking at the totality of the business. The dividend discount model analysis gives me a fair value of $111.80. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Merck as a 4-star stock stock with a fair value estimate of $100. CFRA rates Merck as a 4-star buy with a 12-month target price of $90. We have a small range here. Averaging the three numbers out gives us a final valuation of $100.60, which would indicate the stock is possibly 30% undervalued. Here's the bottom line, guys. Merck & Co. Inc. is a high-quality company that has one of the best-selling and fastest-growing products in its industry. The fundamentals are great and they're only getting better. With a market-beating yield, strong dividend growth, a moderate payout ratio, 10 consecutive years of dividend raises, and the potential that shares are 30% undervalued, this might be one of the very best deals in the market for dividend growth investors. And now for a special news announcement. IDC data recently came out that showed Apple Inc., stock ticker AAPL, dominated the global fourth quarter wearables shipments on the back of strong AirPods and Apple Watch. With their 36% wearables market share, Apple is no longer only an iPhone story. This company continues to get bigger and better. This is another example of why I recently called it a must-own stock for serious dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alert. I'll see you next time.